Hello friends, and if you get your income from Centrelink, the age pension, a part pension, the Commonwealth Seniors Health Card or any support payment, I need 5 minutes of your attention right now. Because there's a specific type of letter landing in mailboxes and MyGov inboxes across the country this year, and thousands of people are opening it, seeing government letterhead, assuming it's routine, and putting it in the drawer. That's the mistake, because this isn't routine. This is Centrelink reassessing what you're entitled to, and depending on how you respond or don't respond, your very next payment can go up, go down, stop altogether, or turn into a debt you didn't know you had. I've gone through how Services Australia actually handles these reviews in 2026, spoken to what the current rules say about deadlines, appeals and mistakes, and I want to walk you through exactly what these letters mean, which ones are urgent, which ones are actually good news in disguise, and what you need to do the moment one shows up. Stick with me to the end, because the third type of letter I cover is the one catching out the most pensioners right now, and almost nobody understands they have a right to fight it. Before we dive in, if you haven't subscribed yet, do it now and switch notifications on. Here's the honest reason that matters. Centrelink doesn't ring you up to explain a policy change. It doesn't send a plain English summary of what's different this quarter. Indexation happens twice a year, asset limits move, deeming rates shift, and eligibility cutoffs get redrawn, and the only signal most pensioners get is a letter written in the driest possible public service language. What I do here is translate that, so subscribe, turn the bell on, and let's get into what these letters actually mean. Why Centrelink sends these letters at all? Here's something a lot of people don't realize. Centrelink isn't watching you specifically. It's running an enormous, largely automated system that cross-checks your reported income, your assets, your relationship status, and your living arrangements against data from other government agencies, the Australian Taxation Office, banks, share registries, even property records. When something doesn't line up, or when a scheduled review date comes around, or when indexation changes the thresholds you're assessed against, the system generates a letter. That means the letter isn't always about something you did wrong. Sometimes it's simply Centrelink saying, "The rules moved, so we need to check where you now sit." But because the letters all look similarly formal and similarly intimidating, people react to a routine reassessment exactly the same way they'd react to a debt notice, with panic or with avoidance. Both reactions can cost you. Letter Type 1. The Income and Assets Review. This is the most common letter, and it usually turns up as a request to update your details, sometimes through a form, sometimes through a prompt in your MyGov account asking you to confirm your bank balances, your shares, your superannuation, or the value of your home contents and vehicles. Here's why this one matters more in 2026 than it might have a few years back. The asset test thresholds move with indexation, and this year they've shifted upward. A single homeowner can now hold close to $722,000 in assessable assets before the pension cuts out completely. That limit was lower before the March adjustment. What that means practically is some people who were knocked back for a part pension in previous years, or who dropped off it because their super or savings sat just above the old cutoff, may now qualify again without doing anything except reporting accurately. But it cuts both ways. If your asset value has grown, say your home contents were revalued, you sold an investment or a term deposit matured and sat in your account, and you don't report that change, Centrelink will eventually catch the mismatch through its data matching, and when it does, it doesn't just adjust you going forward, it can claim back what it decided you were overpaid, sometimes stretching back months. The lesson here is, don't hide your assets. It's report promptly, and don't assume a review letter is bad news until you've actually gone through the numbers. Letter Type 2. The Deeming and Income Reassessment. This one trips up a huge number of self-funded and part pension retirees because most people have no idea what deeming even means, let alone that it can change their payment without their actual income changing at all. Deeming is Centrelink's method of estimating the income your financial assets, bank accounts, term deposits, shares, account-based pensions, using a fixed assumed rate of return, regardless of what those investments are actually earning you. In 2026, the lower deeming rate applies to your first roughly $62,600 in financial assets if you're single, or around $103,800 combined for a couple, with anything above that deemed at the higher rate. Here's the part that catches people out. When deeming rates rise, even slightly, it can be enough to tip someone who was receiving the Commonwealth Seniors Health Card over the income threshold and lose it, even though not $1 of their actual bank interest changed. Losing that card isn't just symbolic, it affects discounted medicines, and increasingly it's tied to what you pay in co-contributions under the aged care system if you ever need in-home support through My Aged Care. If you get a letter referencing deeming or an income reassessment, don't assume it's a clerical formality. Check what threshold you've been placed against, and if your card or payment status has genuinely changed, ask Centrelink directly what triggered it. Letter Type 3, the debt notice. This is the one I promised you at the top, because it's the letter causing the most distress, and it's also the one where the majority of pensioners don't realise they have real rights. A debt notice says Centrelink believes it paid you more than you were entitled to, and it wants that money back, sometimes through a lump sum request, sometimes through automatic deductions from your future fortnightly payments. For someone living on a fixed pension, watching a chunk disappear from your payment with little warning is genuinely frightening, and plenty of retirees simply accept it and start repaying, assuming Centrelink must be right. Here's what most people don't know. You are entitled to ask for a plain explanation of exactly how that debt was calculated, and Centrelink has to give you an answer, typically within about 2 weeks, at no cost to you. You can also ask to pause any repayments while that explanation or a formal review is underway, so you're not losing money before you've even understood why. If, after the explanation, you still believe the debt is wrong, maybe the dates don't match your circumstances, maybe income was double counted, maybe a life event like retirement or losing a spouse wasn't properly factored in, you can request a formal review by an authorised review officer. This is a specialist Centrelink staff member, separate from the original decision, who genuinely has the power to reduce your debt, wipe it entirely if it resulted from a Centrelink error, or confirm it stands. There is no time limit for asking for this review when it comes to a debt specifically, unlike some other Centrelink decisions where a strict window applies. And here's something worth knowing if you've had an old debt hanging over you for years. There's currently a scheme running that lets people who were affected by a flawed calculation method Centrelink used in the past apply for a one-off payment of up to $600 per affected debt, with applications open into early next year. If you've ever had a Centrelink debt that felt like it came out of nowhere or seemed inflated, it's worth checking whether you're one of the people this applies to before that window closes. Letter Type 4, the payment rate adjustment. Not every letter is a warning. Some are simply telling you your payment has gone up, and it's worth understanding why so you can check the numbers right. Indexation happens every March and September, and this year's adjustment lifted the maximum single-age pension to just over $1,200 a fortnight, with couples now receiving a combined rate above $1,800 a fortnight. If you're on a part pension, your specific increase depends on where you sit under the income and assets tests, so the amount will look different for everyone. The point is, if a letter tells you your rate has changed, don't just glance at the new figure and move on. Compare it against what you were expecting from indexation. If the number looks lower than it should, that's worth a phone call, because a clerical error on Centrelink's side is far more common than people assume, and it won't fix itself unless you flag it. What widows and recently bereaved retirees specifically need to watch for. If you've lost a partner recently, you're statistically far more likely to receive one of these reassessment letters in the following months because your household's income and assets position has fundamentally changed. A single age pension rate is different from a couple's combined rate, and your assessable assets may include things like a life insurance payout or superannuation death benefit that weren't there before. Too many widows and widowers simply accept whatever new figure appears without checking it, at exactly the moment in life when they're least equipped to be chasing paperwork. If this applies to you or to someone you know, the single most useful thing you can do is call and specifically ask Centrelink to walk through how the new rate was calculated, referencing your changed circumstances. It costs nothing, and it can catch mistakes before they compound over months. The one habit that protects you from all 4 letter types. Every single one of these situations gets easier if you do one thing. Check your MyGov and Centrelink online account regularly rather than waiting for a physical letter to arrive. Reviews, reassessments, and requests to update your details often show up online before or instead of a posted letter, and the earlier you respond, the less chance there is of a small mismatch snowballing into a formal debt. If you've never logged in or you're not confident using it, ask a family member to sit down with you once and set it up properly. It takes less than an hour, and it's the single easiest way to stay ahead of these changes instead of finding out about them after the fact. Bringing it all together. So here's the short version. If you get an income and assets review, don't assume the worst. With this year's higher thresholds, some people will actually qualify for more, not less. If you get anything mentioning deeming or your income test, check whether it's touched your Commonwealth Seniors Health Card, because that card affects more than just Centrelink. If you get a debt notice, you can ask for a free explanation, pause repayments while you wait, and request a formal review with no time limit. Don't just start paying because a letter told you to. If you get a rate adjustment letter, check the new figure against what indexation should have given you. And if you've recently lost a partner, get Centrelink to walk you through your new calculation line by line. None of these letters are something to fear once you know what they actually mean and what your rights are. The mistake isn't getting the letter, it's putting it in a drawer and hoping it sorts itself out. If this helped you understand what's sitting in your mailbox or your MyGov inbox right now, hit subscribe, and please send this to a parent, a neighbor, or a friend who's on the pension. A 5-minute video today could save someone months of stress or hundreds of dollars down the track. I'll see you in the next one.